Well, thank you very much for having me. Excellent, and thank you guys for attending my presentation today on the crypto standards set forth by the Basel Committee on Banking Supervision. Few words about myself before we jump in. My name is Robert. My background is actually credit risk modeling. I've been doing that for the past 10 years, starting my career in the UK, then Switzerland, and followed back into Germany. And about 3 years ago, I decided to venture into the blockchain space because I wanted to find out how it impacts the financial services sector. Fast forward 3 years, I'm now a senior manager at Zanders, as Marcel mentioned, looking into risk management still, as well as the blockchain offering. And whenever I do have some spare time, I also try to work on my PhD thesis on the valuation of DeFi protocols. Now, just a few quick words about the company itself. Zanders was initially founded in 1994, so we've been around for over, almost 30 years. We were founded as a quantitative risk consultancy, so looking at treasury risk management, credit risk modeling, market risk modeling, asset liability management, etc. That's really our bread and butter. And as of February 2022, when I joined Zanders, we are now also in the blockchain space. And of course, for me, the particularly interesting part is combining these two topics. I should also mention we are a company of about 270 plus people working in 8 different locations worldwide, and we are expanding quite rapidly on a global scale. And of course, I'm particularly proud to announce that as of February last year, we have offices in Germany, 1 in Frankfurt and 1 in Cologne. Now, the reason I'm here today is that risk management is becoming more and more important in the crypto space, as we have noticed in the recent past. Now, my predecessors of today already mentioned quite a lot of regulatory developments: Electronic Securities Act, the MiCA regulation, and then in the previous talk, the DOT pilot regime. Now, one of the topics that isn't mentioned too much in all of these regulatory developments are capital requirements. And capital requirements were initially written when crypto wasn't big yet. So the last update was around 2013. Crypto had existed at that time, but it was nowhere as big as it is these days. So when we look at the capital requirements regulation, crypto isn't mentioned explicitly. It is only defined, or it falls into the category as a non-credit, an other non-credit obligation asset. Which essentially means you have a 100% risk weight. But as the most recent past has shown, risk management has become more and more important. For example, if we look at Silvergate, some asset liability management practices probably would have not been too bad on that side. Similarly, if we look at SVB, again, sort of the real assessment of interest rate risk would have been quite useful. Again, asset liability matching would have been quite useful. And then, of course, the spillover effects into USDC is something that we've all seen quite a bit, and most of our WhatsApp groups probably blew up over the weekends when the stablecoin was depegged temporarily. So today we're going to focus on one component that is going to tackle this, which is the BCBS crypto standard. Now, first of all, that crypto standard is not going to address everything. It's not the solution to all risk management practices in the crypto space, but it is a start. It's also quite comprehensive, so I'm not going to be able to cover everything, but what I really want to focus on is give a quick overview and then really drill into some of the potential pain points that we see, especially compared to the market as we know it. And then, of course, I'm going to round things off with a bit of a practical example. Now, first of all, let's have a look at the classification of assets. So in general, that standard says there's 2 groups of assets, Group 1 and Group 2. And each of those groups, they're subdivided further into 2 groups. Now, Group 1A is something that is very, very close to what we just heard in terms of Electronic Securities Act, because we're talking about traditional financial assets tokenized and brought onto a blockchain. We have group 1B, which is a crypto asset which has an effective stabilization mechanism. And we're going to talk about what that looks like and what it doesn't look like in a moment. Those two groups can fall under existing regulation in terms of risk-weighted asset calculations, etc. Now, anything that doesn't fall into group 1, there things become a bit more punitive, and that is group 2. And again, we have two subcategories. Group 2A is a group that allows some hedging, and group 2B doesn't allow any hedging whatsoever. Now, within group 1, we also have an infrastructure add-on for weak systems, and within group 2, we have an exposure limit. We're going to look into all of those in a bit of detail now. So group 1 is relatively easily explained because, as we heard, it is a tokenized traditional asset. So first of all, as part of that, as long as certain criteria are met and the asset is essentially the same thing as the traditional financial asset, our normal regulation applies. In terms of examples, we're talking about bonds, equities, as soon as we have them on the blockchain in a regulated space, things like derivatives, loans, claims on banks, etc. We also have commodities that fall into this category and cash. Now, the key point is, as long as all legal rights of those assets are the same as for as the traditional financial asset, then we are safe. We are in group 1A. For bonds specifically and equities, there are some additional criteria. For example, you have to make sure that when that asset is due, there is nothing that prevents you from being paid out in full. There are exceptions, however. For example, if you have an asset that needs to be redeemed first into a traditional asset, then it doesn't count. You're out of group 1A. Also, if you have additional risk, such as credit risk or liquidity risk, also it's challenging and you might be thrown out of group 1A. And we heard it earlier in one of the speeches, I think it was 140 million that were issued in digital securities this year. Compared to the traditional financial markets, arguably there's a bit less liquidity than what we are normally seeing. But in general, if we have the same level of credit risk and market risk, then we are fine within group 1A. Now, group 1B is a slightly different story. We're talking about crypto assets here already. In the first group 1A, we were talking about traditional assets. And here we're talking about crypto assets with a effective stabilization mechanism. And essentially what that means is the asset has to be redeemable for a specific fixed amount of money, like we know from stablecoins. One is US dollar, one euro. You can also have a commodity-backed asset in this group. Now, if you want to classify as group 1B, first of all, you have to have a proper monitoring framework in place, and you have to pass redemption risk tests. And those are essentially categorized into three groups, which is first of all the redeemability, and it means your asset has to be redeemable against the peg value at all times, including severe stress times, and we'll get to that in a second. Secondly, you have to have a very, very high asset quality. So the standard mentions level 1 HQLA. And then, of course, you need to have a proper governance framework in place. Now, you see the three exclamation marks there about being able to redeem within, even during times of extreme stress. Now, we all remember what happened to USDC. We can see it here in the chart. It lost its peg at some point during a specific weekend. Now, that is something under the Basel, the BCBS standard, it wouldn't fly. USDC, given the current writing of the text, would not be classified as group 1B. So it would fall into group 2B, most likely. Most importantly, because it was not redeemable against its peg value under severe stress. What does that mean? Long run, we're going to need stress testing for our stablecoins. Let's hypothetically say we pass all of these tests, then we're fine, because then the existing RWA calculations apply. Of course, there are certain risks that we might need to take into account on top of things. Like, for example, if we go through a redeemer and we have open positions with that redeemer, it depends on what type of position it is, whether you have an unsecured position or a secured one, in which case it's either treated as an unsecured loan or a secured loan. But key point is, if we manage to stay in group 1 from an RWA perspective, we are in a fairly good position. We do have an add-on for infrastructure risk, which still needs to be assessed. Currently, the regulator says we set it at 0%, but we're going to monitor this very, very closely. Now, I'm throwing a bit of a bomb out here, and I hope I don't get death threats for this, but certain things like technical stability might become a relevant factor. Things like size of the protocol might become a relevant factor, or legal issues. Now, I'm not saying that these protocols mentioned up here are going to get into trouble. Not by all means. It's just a bit of food for thought for you guys when you think about this on your drive home tonight. But there is an infrastructure risk coming, and it needs to be quantified. Now, Group 2 is where things get a bit more punitive. And Group 2A allows for some hedging strategies. Key point here is you have to fulfill these criteria all in all. So you have to fulfill the green box criteria, the blue box criteria, and the red box criteria, which essentially means you have to have a derivative that is either traded on a regulated exchange or derivative or ETN, by the way, or it was approved by a regulator and goes through a CCP, or you have an ETF or derivative or ETN that references such an ETF, ETN or derivative that passes these criteria. Then it has to be based on a crypto asset that is highly liquid. So we have a test on market capitalization, and we have a test on daily trading volume. The one boundary is $10 billion, the other one is $50 million. So it has to be a relatively liquid asset. And then to top things off, we also have specific criteria regarding data availability. Only if those conditions are met, then we are actually allowed to we're allowed to classify as Group 2A. That doesn't mean that your entire hedge will be recognized. So you can hopefully see the formula up there. Even if you have the perfect hedge, only 65% of your hedge will be recognized. So going with that perfect hedge analogy, you still have to have capital requirements, even though your hedging strategy might be absolutely flawless. For those remaining 35%, you will have to have capital requirements in the same amount as you have outstanding exposure. So it's basically a one-to-one relationship. Now, and there's one very, very important thing here. Netting across institutions is not allowed. So if you have one long position on exchange 1 and a short position on exchange 2, forget about netting. It's not allowed, and you will have to treat your exposures separately. Of course, we do have some additional requirements for options and the way we calculate sensitivities and the slides from a market risk perspective. We're not going to have time to do that today, but happy to pick up that conversation at a later point. But key point here really is number one, the netting and the non-netting across different exchanges. And just to give you an example, I pulled out some assets, and I'll tell you why I pulled out those assets in a second, to check whether they would pass those tests. And as you can see here, for most of them, we're okay. Market cap tests are fine, trading volume tests, ETN and ETPs are available, and they go through regulated exchanges. However, as you see there, Litecoin and Stellar, for example, just like Polkadot, they fail the market cap test. So they would not be classified as Group 2. Which brings me on to Group 2B. Now, from a regulatory perspective, this is where the biggest change comes in. Because I mentioned at the very beginning, we had a 100% RWA under the old CRR. Now, with that new BCBS standard, that 100% is increasing to 1,250%. So we talk about a factor of 12.5, essentially. So very, very punitive. The way you calculate your risk-weighted assets is given in that formula up there. It's essentially the maximum of your long and short positions, both in absolute values. Now, that fallback approach is supposed to cover everything, including credit risk, market risk, CVA, you name it. So it is quite conservative, as it is called. And it doesn't only apply to Group 2, the single assets. It also applies to funds or any sort of investments, derivatives, or short positions in those funds. So a fund of crypto assets, for example, would fall into the exact same category here. If you have leverage positions, that also needs to be taken into account. So essentially, the higher your leverage, the more you need to adjust your exposure upward. But you're allowed to cap it, and gracefully you're allowed to cap it at your maximum possible loss. So great. Overall, quite a punitive position to be in. And I pulled out an example from an actual bank who has crypto on their books. And for 2021, they filed the following numbers. They mentioned RWAs in the crypto risk space of about 61 million. Now, if you sort of calculate that back, make a few assumptions regarding 100% risk weight and the sort of traditional 8% on the exposure, that translates into 770 million in terms of Swiss francs exposure on their books. And now let's imagine that they have an unhedged position against the USDC. And all of that 770 million is in USDC. What will happen is that risk factor or risk weight factor of 12.5 would significantly increase their risk-weighted assets in that category. So we would jump from 61 million to 770 million from one day to the next. And of course, so first of all, that's a big jump, but it also has a huge impact on the CET1 ratio. Initially, it was 17.7%. With that change going live, we would immediately drop to 3.7. So that is the situation where additional capital would have to be made available. Similarly, if you look at other crypto assets, and I pulled out an example here from another BCBS study, which looked at what type of assets banks usually hold on their books. We have a similar situation. With that 770 million exposure, essentially our risk-weighted assets would jump again to 770 million and our ratio, CET1 ratio would drop to 3.7%. Key point here is there would be no difference whether at the time of reporting I hold USDC or Bitcoin. The only difference over time is if my Bitcoin starts to appreciate in value and the next year my Bitcoin is worth more, my capital requirements would, my CET1 ratio would look even worse. And I think I need to hurry up a little bit. So I'll leave you with a few thoughts. First of all, for Group 2, you have an exposure limit. You are supposed to only have 1% of your CET1 capital in, sort of, or a 1% of your CET1 ratio in crypto assets exposure. And you're forbidden to have more than 2%. Now, in case you do breach any of those rules, the supervisor can start breathing down your neck in the form of additional capital charges or additional provisioning. And it quite clearly says losses that are foreseeable and estimable, which means you need to start forecasting and estimate your losses on crypto assets. And there can also be other mitigating measures. Final and key point, if you breach that 2% limit, then all your Group 2 exposures are measured under the Group 2B approach. So as soon as you breach, you have even bigger problems because your netting and hedging all of a sudden will not be recognized anymore. So in case you're realizing that you probably need to do an impact assessment of this, please do find us in our booth. We are near where where lunch was served. So on that note, thank you very much for listening and hopefully speak to some of you soon.